Right, let's bring in Michael Yoshikami then, CEO and founder of Destination Wealth Management. Michael, good to see you. Thanks for joining us. What do you think is happening in the markets, and what does that tell us about coming sessions?
I think the market is just completely uncertain about what the next 6 months are going to be like in terms of interest rates, what's happening in Russia. The pandemic continues to drag on here in the United States. What's that going to mean for global trade? So I think we really are at an inflection point where we have a lot of issues. After a very strong run-up in the fourth quarter of last year, a lot of the issues the market just can't make sense of. And when the market can't make sense of these issues, it tends to sell off and be volatile, and that's what we saw yesterday.
There's been a lot of speculation that we're finally hitting the kind of numbers where there is value. Do you think buying on the dip at this point makes sense on very weak days?
Yeah, I would be very, very careful about buying on the dip. I still think, as you mentioned, I think futures right now are a couple hundred points lower. So I think that you shouldn't get, this is not an all clear signal. I think it certainly is maybe time to start taking a look at what carcasses are out there that you can pick up at cheap prices. But I think overall the market is still pretty reasonably, pretty fairly priced, not really much of a discount. That's why we tend to focus more on dividend-oriented assets in this kind of environment, because growth, I just don't think it's going to get rewarded right now with this rise in interest rates we're likely to see in the United States.
Michael, it's Karen jumping in. There was a lot of reporting around bear market territory for particular indices, but also for certain stocks. And as we talk about that in a historical context, a lot of market participants start to get interested when we talk about 20% pullback in some stocks. But in this particular case, we're talking about technology names that have rallied multiple digits. So it doesn't matter as much when you see bear market territory this time around.
That is a great point, Karen. If you have a stock that's gone up 75%, and then it goes down 20%, does that necessarily make it cheap? I think the answer is no. You have to look at what the real valuation is going to look like. And particularly with a lot of these stocks that really are pandemic-related stocks that are really reopening trade, you got to really be very, very careful with these names, because after strong rallies, it really does, this whole 20% down automatically means it's a great value. It's just not the case. One thing I do want to bring up, Karen, that investors oftentimes forget in the trauma of these downturns is how fast the market, for example, in a correction, let's call a correction 10%, the average amount of time in the last 30, 40 years that it's taken to overcome that 10% correction. You know what the average amount of time has been? It's only been 4 or 5 months. So if investors don't panic, they focus on value, they focus on quality, they can still look past the carnage we see right now and still have some sense of optimism.